Welcome everybody. Chris J Snook. Glad to see you hopping in the room. Please, we're right at high noon on the West Coast here, so please as you come in, just let me know you can hear me okay. Throw maybe the state you're calling in from in the chat, and we'll be getting underway here very shortly. Just going to run a couple technical checks, make sure that you can see everything. So welcome to the webinar. We are going to put 10 pounds of sausage in the proverbial 5-pound bag today, as I like to say. This will probably be part one of 3. This one's focused primarily on what I think investors are going to care about and what they need to know. We'll do one for business owners looking at operating in qualified opportunity zones as it relates to these new regulations as well. But thank you for being here. Let me know you're here and that you can hear me okay, and we will get started. As you're popping on, please just feel free to let us know who you are or where you're calling in from. Just want to make sure that you'll be able to ask me questions in the chat as we go. I'll get to as many as I can. I'm going to try and keep this tight to 30 minutes. It may go to 35 minutes, so we'll look to only keep you interested with the best of the information we can and jump in about 30 seconds. Thank you, Stephen. I appreciate that. And if you don't mind, we can also throw your name up here in this poll, or not your name, sorry, just tag yourself if you're an accredited investor, if you're a fund manager, if you're someone from government or policy, if you're a developer / real estate person, or if you're a business owner, entrepreneur. Just helps me understand who showed up today, and I can tailor my pitch a little bit to your questions and your concerns as we go. I'm going to pull up the slide deck here. Thanks. We're getting some of those feedback in so far. Other fund managers are on the line. Thanks for being here. Hopefully we learn from each other, and I look forward to building a relationship with you. All right, so I am going to throw up the slide share, and we'll get right in. I see other people jumping in. Thanks for being here. We're just getting underway. And all right, here we go. So you should be able to see my slides. Give me a thumbs up in the chat if you can see those. Opportunity Zone Fund Regulatory Update, today's date, and we are underway. Chris J Snook here. Thanks for tuning in. So big disclaimer up front. I'm not a CPA. I'm not a tax attorney, not licensed to do those things. Take everything you learn here from a educational and conceptual basis. I do manage a fund. I'm part of a fund. And so we, separately from this, we do have LPs and things like that. However, as it relates to this broadcast, this is not something you should construe as financial advice, and the legal disclaimers are now done and the attorneys are happy. So let's get to the fun stuff. All right. For those of you who already know this, just to level set, the intent of the Opportunity Zone package and legislation was to unlock potentially $6.1 trillion sitting on the sideline. There were 8,700 Opportunity Zone tracts, which represents roughly 12% of the U.S. Land and its territories that were designated. They were designated by the local, state, municipality government officials. And this legislation is federal legislation. And it allows for people very simply to take capital gains that were from non-real estate capital gains. They could use those, but for the most part, most people just do 1031 exchanges. This allows for other capital gains, stock sales, business sales, things like that, to be dedicated or elected into a qualified opportunity zone fund or investment vehicle, which we'll talk about the 3 ways you can do that in a second, just to level set everybody, and have deferred tax on that for up to 7 years. The next tax payment would be due in 2026, and you would get a step up in basis of either 10% at the 5-year mark or 15% at the 7-year mark, and then any capital gains that were appreciated off of that basis for a period of 10 years and held in are exempt permanently. So that's why everyone's excited. That's what's unique about this. And again, we covered this on a prior webinar, but I just want to level set in case some of you are new. I see we have 33% of you right now as fund managers, 33% as accredited, according to the poll. I'll leave that up for a little bit longer. The other 33 are business owner entrepreneurs. So an even mix so far. Thank you for tuning in. There are 3 ways right now that you can primarily think about how you could invest in an opportunity zone. If you're looking at it from an investment standpoint, there were 100 plus funds active as of right now that have been formed in the last 12 to 15 months. I would imagine there'll be another 300 to 400 now that the regulations are much clearer that start to appear. So this space is new, it's fresh, and it's about to get really crowded. Thank you for your time and energy today to try and win some of your attention as it relates to this. So there's three options that people can choose, and then we're going to get into the regulatory updates. But I just want to kind of focus us in on the way that you can be thinking about these updates and what they mean to you, because some of you are looking at doing direct investment into an opportunity zone project. Some of you are forming or looking at joining a single purpose entity, which is the second vehicle. And then obviously the bulk of you will end up either being part of or managing, like I am, a qualified opportunity zone fund. And these funds will range inside from the single digit millions to things like us, where we have three separate $500 million funds kind of chartered, with two of them open and one of them closing literally this month. And so those are the three ways in. And we did a thing on the last webinar. You can find it on YouTube that went into depth a little bit more on the pros and cons, talked about apples to apples as it relates to fees versus non-fee structure things. So I encourage you to check it out on YouTube. You can go to J Snook on YouTube and you can see that full-length webinar and also several of the clips underneath the Opportunity Zone Investing channel. So feel free to check those out. 5, 7, and 10, and then we're almost through the baseline, and I'm going to take a breath and just check the chat for any alerts. Jeff, you can't hear anything. Anyone else having that trouble? Steven, anybody else having trouble with the hearing? I want to make sure I don't go too much further. If you cannot hear, can you hear me? That's not a good sign. Anybody, we'll take a quick pause. Can you let me know if you can hear the voice? All good. Okay, so sorry, Jeff. We'll send out the replay too, but please hang in there. Feel free to reset your browser or something. But thank you, Stephen. I just want to make sure that for the recording that we're all good, and for the rest of you, we're all good. So, all right. So 5 years means essentially, in the regulations had this from October, but then they reasserted this in the April 17th issue. And essentially, after 5 years, there's a permanent exclusion from gross income of 10% of your original deferred gain. So essentially a 10% step up in basis. After 7 years in a qualified opportunity zone fund, you'll get a permanent exclusion from your gross income of 15% off your original deferred gain. And after 10 years, the big whammy, as we already talked about earlier, is the taxpayer can elect to exclude all the post-acquisition gain from all the investments in the qualified opportunity zone fund that were held for at least 10 years. What this means in layman's terms is if you had a capital gains of $1 million this year for simple math, and you put all of that into a qualified opportunity zone fund or investment, after 5 years, you wouldn't have to pay any tax until 2026. But if after 5 years, when you pay that tax, if you were to take it out before 7, you would have a 10% step up in basis. So you essentially get a 10% reduction on your capital gains tax. And if you had it in for 7 years and paid it on 2026, when all of it will be due from the deferment, you will get a 15% step up in basis. And so instead of paying tax on $1 million, you'll pay tax on $850,000. But if that $1 million over the next 10 years is worth $2.5 or $3 million because you average a 7 or 8 or 9% return, then that delta, that extra $1.5 million, will be tax exempt, and you won't pay anything on that. So that's a big deal. All right, I think we've level set everybody. I just want to make sure we cover our bases. Anything in the chat that we should do before we go into the updated rules? Because here's the things that are incomplete. So feel free to fire questions in the chat now, comments, whatever you want. We are now at 20% accredited, 40% fund managers. So I'm talking to a lot of my peers. Thank you for tuning in. I look forward to tuning into your webinars. And now we're at 20% real estate developer, 20% business owner. So I love it. We're very balanced. Thank you for being here. All right. Admin rules on Form 8996 are incomplete. The next update will be July 9th, 2019. Essentially what that means is there's still some comments that are being requested by the Treasury and by IRS to decide whether or not, as it relates to maintaining the 90% asset test, if they need revisions to the form that could include things like each investment's EIN and amount invested. So, almost like an itemized sheet. So that will be a lot more clear July 9th, 2019. Not a major change, just something that's to be aware of if you are working with your tax professionals or thinking about what you might be able to be prepared for. And so fund managers are obviously already preparing for that. But for those of you doing SPEs or direct investments, you might want to be keeping good records in the event that you have to be more detailed on those forms. The other thing that is incomplete as of this last publication was tangible property compliance. Again, the commentary that is being requested and will be finalized, we're being told around July 9th, is whether or not to keep the asset by asset test for substantial improvements, which we'll talk about here in a second, or to adopt an aggregate approach to provide additional compliance flexibility. The way I read that, but it'll be much more clear in July, is that they're leaning towards an aggregate approach, but again, too early to tell. Last thing, special election privileges. This would be really relevant to people that are doing SPEs and things like that. So with respect to a special election provision, meaning if you're direct investing into some kind of QOF partnership or an S Corp, the IRS is intending to implement some more detail around anti-abuse provisions that'll address straddles and things like that in the next iteration. So those are the things that are incomplete. What can we glean from the 169 pages of fresh new IRS wonderment that they just dropped on us? Jonathan, thanks. I see your questions and I will make sure I get to them. So hang in there and we'll weave those in. I appreciate you sending them in now because I can weave them into some of these slides. So I'm just going to read that one. Got it. Okay, so I'm back to the key insights and then I will work that one in, Jonathan, into one of the upcoming slides. Perfect. All right, so here are things that investors are going to care about. I'm going to hit these up front, and then I'm going to focus on specific language, meaning specific terminology that you're going to see a lot as you read this, as well as you just start to study this more or listen in. You're going to start to hear some of these terms, and I've tried to take these 169 pages and distill them down to like simple 10 slides. So we literally have 17 minutes to go, and we're going to get through 100, maybe 45 pages of it that I think are the most pressing for investors. But let's talk about inclusions, because essentially what this means is these are the 11 things, layman's terms, that imply that you are cashing out. Now, remember, the benefit to your QOF investment election is to leave it and let it ride, meaning leave the gains and let it ride for 10 years. However, in some situations, you may choose that it's worth cashing out at any point along that, some or all of it, depending, but some of it. And so what are the things that would trigger cashing out and what are the things that do not? Meaning, how could you move that money around into different estate structures and things like that without triggering it? So this is very clear and clarifying. And so here's what they are. Real sexy stuff here. Taxable disposition of all or part of the QF investment. Essentially, if you dispose of the investment or if your fund does and they don't abide by some of the rules that we'll talk about in a second, like the 12-month reinvestment thing, that would qualify as cashing out. And so the tax would come due. Now, if that was after 5 years, you're going to get that 10% step-up basis. If that was after 7, 15. But if it was before 10, you're not going to get the full exemption on the gain above your basis. So again, cashing out. Taxable disposition of an S Corp that holds an interest in QOF ownership that is where there's a management change greater than 25%. So this might stick around to Jonathan's question a little bit. Jonathan's question is, can you buy the shares of a wholly owned entity off of another party rather than leaving your money and theirs in the entity? I might ask you for some clarification on that, Jonathan, because I kind of get it, but I'm not sure I totally understand the question or what you're trying to ask there. So feel free to put some more into the chat as I keep talking. What is the ratio of equity to debt when developing a building, and how is it related to the land value versus construction costs? Okay, we're going to hit on that in a second. So that one we'll get on when we talk about land banking and some of the other things here in a second, substantial improvements. But the first one may be related to this disposition event. So give me some more comments in there, Jonathan, to clarify maybe that question a little better, and I want to make sure I answer it. In certain cases, a transfer by a partner of an interest held directly or indirectly. And so in certain cases, a transfer, so you'll have to get with the tax people on that. But obviously, if you transfer your interest and you do it a certain way versus another way, it could trigger a cashing out event. Now, here's where we'll get a little bit more detailed on what you can do, because they've spelled this out in the new guidelines. A transfer by gift of a qualifying investment if the gift that would trigger it, right? So if you transfer this as a gift, you give it to your father, your kid, your mother, whatever, then that would trigger cashing out, and the tax would become due, and at whatever discounted basis or not that it is based on when you did it. However, if you take your interest, so your limited partnership stake or whatever it is in the QOF, and you gift that to a grantor trust or through your estate, then that's excluded. Meaning, you can gift this from one way of holding it, either as an individual or whatever, to your grantor trust, which you are the owner of, and that would not trigger, because essentially, even though you're transferring the entity by which it owns it, because it's your trust or you own it, they're letting you do that. Again, that's really good for estate planning purposes. So that's a non-triggering event. So again, transferring it as a gift will trigger. However, if you gift it to your grantor trust or through your estate properly, then you will not. And so that's good. Get with your accountant again on that to figure out exactly how to do that and what kind of things you may need to be thinking about as it relates to your long-term estate planning and making sure those gains are tax exempt. Distribution to a partner that has value greater than the basis invested. Distribution of property of QF stock under 301. Again, I'm going to throw up right now so that you don't have to ask me what 301 is, and I don't have to waste time being boring because I'm not an accountant. I'm going to give you the 169 pages just in case you have not had access to it. So if you go here and you can download this comes right off the IRS's site. You can go deep into here. I forget exactly which page 301 and 302 are on, but as it relates to these other ones, you can kind of find it. It's actually pretty readable. And so, look for those sections and get yourself familiar with these inclusions. We'll talk about those if they come up in specific questions, but here's what the 11 are. Let's talk about some key terms and then get to some questions here. So substantially all. Now, what this means is 70% of tangible property must be owned or leased inside of the QOF. So for an investment to qualify, it must substantially all, that'll be the term that you'll see, in a qualified opportunity zone. And so 90%, so if an investment is 70%, so I'm going to do this, I'm going to come off screen here for a second, stop the file share and just show this on camera. So I'm going to use Q-tips because they're visual. So that's 70% of this Q-tip. So if I invest in this Q-tip and the green represents the amount of this Q-tip's assets that are inside of a QOZ, it is a qualified investment, meaning it will be allowed and all those rules apply. However, if it's 50%, it's not. And so when you look at these investments, that's part one. Now, part two is the key part that can confuse the heck out of people the first time they read it, confused me the first time I read it. So I'm going to pull this back up. Over the 10-year period, the 90% asset test also applies. So what that means is that if I have, let's say this box is my 10-year period, and I have 10 investments that are 70% tangible assets owned or leased inside of a qualified opportunity zone, okay, then I need to maintain at least 9 of them for that 10-year period. So I could have 9 out of my 10. So if these were each $1 million investments, at the end of that 10 years, 90% of my investments has to be in a qualified opportunity zone. So let's say I really like this property, but it's only at 50%. I got to have this property as part of the fund's 10% allocation to a non-qualified opportunity zone investment. But the 90% of my assets under in my investments must be qualified over 70, and they must be in that zone for the 10-year period. So visually, just trying to make sense of the IRS's language for you. And so we'll go back to the slide presentation now that you've seen enough of my face. All right. So that's what substantially all. Now, asset churn, let's talk about asset churn. The genius part of these new regulations and these new guidelines was I think they really thought this through appropriately. My overall gist of this updated regulation is it's really good legislation. It really is heading in the right direction. They are stopping the abuse opportunities, I think, in advance. And yet at the same time, they're not over-regulating, and they're keeping things pretty sensible and pretty interesting as it relates to how money and capital and economic development really needs to work. And so I'm impressed by the law personally. That's my gut level. And here's one of the reasons why. Asset churn. So in the original October 2018 guidance, there was a 90-day period where if you sold this investment, so remember, I got to leave 90% assets under management in my thing for 10 years, right? 90% asset test. Well, let's say this business, I bought into it and this property was worth X and now it's worth 3X and there's a buyer and I want to sell it. Well, there in the original language, it was 90 days to redeploy that capital, reinvest that capital and not have a penalty or not have it disqualified. Now they're giving you 12 months. So when it comes to asset churn, this is going to allow fund managers specifically the ability to be patient, look at quality deal flow, run a strategy of both divestiture and everything else, while in the meantime, their LPs can just benefit from the IRR and the ongoing reporting and everything else. So that 12-month window is definitely healthy enough. It's not even 6 months. It's 12 full months before you would possibly fall out of that 90% asset test ratio. So I mean, I don't think it gets any better than that personally. It's just my opinion. All right, original use. Lots of questions about this. And one of the biggest things I think that this guidance provided is related to leasing, but we'll get about that in a second. So original use means they've now said that a tangible property that will qualify must be inside of an opportunity zone, but it has not yet been depreciated by any taxpayer. So not even just you, can't be depreciated by any taxpayer. Vacant property. The property, if it's vacant, has to have been vacant for 5 years. They did this primarily so that when the law first passed 18 months ago or whenever it was, that people couldn't just permanently vacate a building that was in a zone that they already had so that they could get it triggered inside of it as a new thing. So the original use is 5 years vacancy, not yet depreciated. And the new language that's great is that any improvements, so tenant improvements, build out, any improvements that are made on a leased property actually now qualify as original use, which is really good. And the original use requirement does not apply to land. So we'll talk about that here in a second in more detail, but these are good things. Such business is a term you'll see and read a lot as you download the file that I shared. What this means is that there's 3 safe harbor tests. All you have to do is pass one. So for the business owners, there's 20% of you on this right now that are business owners trying to figure out, can I start a business or can I expand my business and benefit from both capital attraction as well as my own, maybe if I'm taking capital gains from another thing and I'm reinvesting to expand one of my own businesses and I do it in a zone, how do I qualify? Well, in the original language, it was kind of unclear. It said 50% of your gross income must come from inside the opportunity zone, but that was nebulous. It wasn't really clear. They've gotten a lot of commentary. They've taken that to account, and now there's a 3-test safe harbor test that if you qualify for one of these, you're good. And so you can pick any one of these or more than one, and your business will qualify as opportunity zone business in such business. What that means is 50% of your services or hours that are paid via W-2 or 1099 are within the QOZ. So example, I'm a startup software company. I've got people that are offshore developing in India, but I've also got designers or front-end people that are developing and working for my startup, and I put my startup in where I'm at right now, which is Old Town Scottsdale inside of an opportunity zone track. If I build my startup here and I have 10 people that I'm paying either via W-2 or 1099, and 5 of them, meaning let's say they're all making the same amount of money just for simple math, if 5 or more of them are coming into this office and working from this office, whether they're W-2 or 1099, I qualify. So this allows, now my product's being sold all over the world, right? So I'm a SaaS startup. So what this solves is it doesn't disincentivize software companies and service-oriented companies that may have a global client base that is not in opportunity zones from being able to qualify as an opportunity zone business. This is huge for, especially when you're talking about economic development and the purpose and intent of this, which is to engage new communities and new innovation in parts of the world that aren't Silicon Valley or New York or Boston. And so that's one. The other way is a 50% of the payroll or contractor expenses. Again, maybe an agency, something like that. And the third is tangible property and operations. So think of a landscaper. If I put my headquarters or my warehouse and I have my operations team and my employees and all my equipment here, but 90% of my employees are out mowing lawns all around the town in non-opportunity zones. As long as my tangible properties and operations staff are in my qualified opportunity zone footprint and in my building, then I qualify. So again, providing the ability to have a headquarters and job creation inside the zone, even if that job and that service is consumed in non-opportunity zones. One of the other things that they're receiving commentary on still that is very interesting for e-commerce type businesses or people that are inventory heavy is that right now inventory in transit has been deemed as yours and will add to your 90% qualified zone asset test, even if it's in transit. So this is good because, again, people were worried about what if at the end of the year I've got a bunch of product that's on trucks outside of my office, outside of my warehouse that's in a zone, and it's not yet at my customer. Am I going to pass or fail the asset test? What they're saying is as long as it's in transit, it's still yours. And if it left your building and your building was inside of an opportunity zone, it counts. What they're also looking for, and I think they're leaning to based on how I read this update, is they're looking on whether they're going to remove inventory as part of the numerator denominator asset test anyway. That would be simple and a lot easier from a regulatory standpoint to maintain, and it would be a boom for people that want to run e-commerce businesses and things that would just be optional. So I think they're going to lean that way based on how I read it. I don't know. July 9th, we'll all know. All right, winding up today, and then we'll get to a couple of your questions and call it a good session. Substantially improved. This goes to Jonathan's earlier part 2 question. 100% above basis is what the amount is that you have to invest in a property in order for it to be considered substantially improved, and that means it would qualify. So again, if you bought a piece of property for $1 million, and we'll talk about this, land is excluded from this, which is great, especially in urban areas where land is the bulk of the cost. If you bought a building and the building itself had a basis of $1 million, you need to put $1 million into it. But if you bought that building and the land that it sits on for $3 million, you only have to improve it $1 million. That's essentially the way to read this. So the land value below the building of the pre-existing structure does not get included in this basis as it relates to what it is like to substantially improve it. And that's huge because part of the intent of this law, again, is to revitalize areas, historic neighborhoods, things that have fallen into blight that at one time, maybe in a different generation, were thriving. And so this really solves that problem, and it allows capital and funds to look at that and see that as possibly appetizing. The time limit from acquisition to complete your substantial improvements is 30 months. This way you can't sit on it and not do anything. Along those lines, it's very clear in these new updates that they have taken away the risk of speculative land banking as part of the anti-abuse provisions. And so there's a lot of language around that and the different ways that they're attacking that. But the net of it is that there are anti-abuse provisions in place to prevent this speculation. You must substantially improve that land for business or trade. The example given is you can't just purchase a strawberry field that's inside of an opportunity zone as a going concern and not put substantial improvements in it. So, that's the way they're landing down on land banking. Now, debt financed distributions. Jonathan, this kind of touches on some of your question. This is another big enhancement here as it relates to providing for liquidity to the LPs in the fund or to the people that need to pay their taxes in 2026 but may not want to divest the asset. For fund managers that are trying to figure out how to tier out distributions to allow for those things and also not have capital calls. And so debt finance distributions have been regulated and approved. What this means is that qualified opportunity zone funds can use leverage to pay out distributions. Those debt finance distributions cannot exceed the investor's original basis. That kind of makes sense, as increased by the investor's share of the debt in its qualified opportunity zone fund. So based on your pro rata share of the AUM that fund has under management, you have your basis and then whatever your gains are. And so the fund could take out debt or leverage up some of its investments to pay out distributions and provide liquidity. And yet, as long as it's not over that, they're not going to have a cash out trigger. So I'm going to go to questions. This is where you can find me. If you want to book a one-on-one call, if you're an accredited or if you're a fund manager that is potentially nationwide in markets that we are not, we're primarily in the Bay Area, Rocky Mountain Southwest, Chicago, Boston, and South Florida. And so those are kind of where we're investing at present. Doesn't mean we won't expand that, but that's where our current deal flow is. If you're a fund manager looking to syndicate with experts in that market, feel free to give me a ring. If you're in markets that we're not and you'd like us to look at syndicating, please give me a ring. If you're an accredited investor and you're trying to find a home for some or all of your capital gains, obviously, hello, I'm Chris. Nice to meet you. If you're a business owner, entrepreneur, what I would say is start to really educate yourself on the funds that have a focus in your market and start to do a little bit, maybe go to the YouTube and look at some of the things I did for developers and business owners on how you could stand out. Deal flow is not the issue, as is with any kind of venture capital or private equity. So if you really want to understand how you could stand out or even potentially self-certify, if you have a portfolio of assets and you want to understand how to self-certify, you want to Google and look up stuff on self-certification and Form 8996 and see if it makes sense to set up your own little special purpose entity to invest as you're expanding. So those are my advices. That's where you get me. One-on-one appointments can be scheduled freely for 15 minutes at havecoffeewithchris.com. Questions and chat. Let's see. Jonathan, I love it, man. You are all over it. Let me just see if there's anybody else. Anybody else, feel free to compete with Jonathan. I love that he is asking us a bunch of questions. So if one party owns all the shares in an entity and develops a building through completion, can a second unrelated party buy all the shares in the entity and effectively take the place of the first owner developer? Or must the second party be the original developer that is substantially improving the land? Thank you. Now that's actually a very good question. So the nut of this is when a investment has been made by someone and they have done the substantial improvements, will the person who comes and buys that asset after the fact still be able to have it as a qualified opportunity zone investment? Meaning, will it pass their 90% asset test? Is it 70% or more tangible assets? Does it meet substantial improvement from their case? And is it inside of a zone? And the short answer is I am not sure on that. So I'd love to actually research that. That's a really good question. I'd love to research that a little bit more and maybe take that one offline, come back around with another question. What I do know is that this is the other side of this is what happens to party number one, right? So when we think about party number one, as it relates to this question, you're talking about a couple things that you're going to be needing to think about. One is asset churn, right? So you'll have 12 months, Jonathan, assuming that if you're the fund or if you're the SPE or the private direct investment that built and improved this thing, in order for you to roll that into and not have any of those gains that you're now punching out early, because I'm assuming you're saying I'm going to build this thing and then in a year, 2, 3 years, we're going to flip it to somebody. When you flip it, there's going to be a profit made. And so for you, you're going to, that first party for sure is going to be selling this now substantially improved, and you're going to have asset churn, and you're going to want to roll that gain into some form of qualified opportunity zone investment. And you'll have 12 months to do that, to have it not impact you or create a taxable event. And so those are some of the things that in the scenario would happen to party one. As far as party two goes, my gut says that you can't have it qualify without substantially improving it further. But that may not be 100% true. And that's a really good question, because depending on what that building is, meaning, is it a multi-use thing? Is it a lease? Is it like what are the revenue sources of that? And what is that new acquirer going to do with it? There may be ways to still qualify it. So I'll look into that further. Thanks. That's a great question. Let's see. Other questions were, what is the ratio of equity to debt when developing a building and how related to the land value versus construction costs? I think we answered that one as it relates to land is excluded. The basis of the building is what you would do. And so your 100% substantial improvement would be based on the pre-existing structure and not the dirt that it's on. If you buy land, raw land or something like that, then, land is again excluded, and so you have to basically you're building a ground up project, in which case you're substantially improving it. And so $1 million land purchase, $3 million construction budget. Can I buy the land with my capital gains equity and get a loan for the entire construction? You know what you'd probably end up doing is you'd probably, whether it's a loan or whether it's equity, you would probably talk with a qualified opportunity zone fund. At some point you'd have to refinance that. So what I would suggest is that as a developer there, you partner with, or you let a couple of funds know what you're up to and see if you can get the investment from them, because they would possibly like your deal, and then you'd solve that problem. And Jonathan, feel free, depending on what market you're in, it sounds like you're one of the developers that's on the line, so feel free to email me personally too, and we can take some of these offline, maybe in a conversation, because I can't hear you and it might be a little faster to answer some of these. These are great questions, by the way. Anybody else have questions? We're at the top of, a little bit past our 30 minutes, and we'll be doing more of these. Again, there's 169 pages. I'm going to throw that file up again. This represents probably the first 35 to 40 that kind of summarize it. Some of the key terms that I think are the most important. And you can download the full amount here. I'll be doing one more that is focused primarily on business owners looking to attract capital from QOFs, as well as potentially invest in expanding their business into an opportunity zone, and some of the implications there, because there's different things I'd be focusing on as it relates to that if I was just a business owner. And I would put developers into that too. So Jonathan, that might be relevant for you. Fund managers, again, thank you for your time. I look forward to learning more about who you are, and maybe attending one of your webinars and getting your feedback on how we did digesting this in less than a week and trying to create something in 30 minutes. So thanks, guys. Appreciate you. If there's no further questions, I'll let you get back to your day, and I'm out.